beyond profit, we can think of a different financial performance measure, return on investment. And that provides us, as managers and employees and owners, a better picture of how well are resources being used inside of the organization. Now, one question that comes about, the assets that we have, are they being used effectively and efficiently? Are long-term investment decisions being evaluated appropriately? Capital budgeting decisions were made long ago based on estimates. Measures like our return on investment allow managers to evaluate that original decision and the decision process that was implemented. And finally, learning more about how well we did in our decision process in the past facilitates future decisions. So in considering return on investment, we need to think about how firms have evolved. The development of communication, technology, and markets leads firms to broaden their scope from pure specialization entities. You can imagine a farm long ago. It would specialize in a particular type of livestock or crop. But given the advent of communication, technology, and markets, farms can become more broad in terms of the type of livestock they raise and or the crops that they grow. And of course, we see the development of global multinational corporations. Organizations ultimately can become larger via these advances. And that means that owners are not necessarily the people working for the firm. They're more likely to be investors looking for a return on investment. So ownership has separated out from many different types of organizations, especially as they have become larger. And in doing that, owners care about how well their investment is doing. Return on investment financial performance measure allows for a picture of that performance. Return on investment, generically, is equal to some profit measure divided by some value of an investment, typically assets. Other financial ratios comprise this return on investment measure. Specifically, profit divided by sales, which is generically referred to as return on sales. That's the proportion of every dollar of revenue earned that ends up as profits. And then sales divided by assets, which is a turnover measure. That represents how quickly or how frequently assets are being converted into sales dollars. Those two financial ratios multiplied yield the measure that we are focused on, return on investment. Again, profit divided by some asset or investment measure. So, return on investment is some return divided by an investment base. But there is an issue with this measure. Specifically, there's too many choices regarding the inputs into what this financial measure represents. With respect to the numerator, the return or profit number can be anything you want it to be. It can be the bottom line net income for a division, or you could take net income before taxes. It might even be, in some cases, gross margin. Because this measure is being used for internal purposes, it can be whatever you want it to be in terms of the numerator being used to represent returns. The same goes for the denominator. What is this asset or investment measure? Well, it can be net assets. It could be controllable assets for that particular division. Again, the choice is up to the managers who are creating and relying on this measure. The point here would be to be consistent so that comparisons can be made within the firm between different types of investments and the returns they generate. There are some other issues with return on investment as well. One, there is still a focus on the short term. So it's not much different than profit in that sense. It's period specific. We're counting a return for a given month, quarter, or year. We can manipulate the numbers as well. Accounting choices such as accruals that are made or the decision to expense a cost versus capitalize it and include it as part of your asset value, that manipulates the numerator. And the same thing can be said about the denominator. We can ultimately reduce our investment level to make return on investment look better. A smaller denominator increases the ratio. So manipulations and a focus on the short term are some of the issues associated with return on investment.